Open up the news every single day. There's a crisis here or there. In this video, I'm going to explain something to you that really highlights what we're dealing with. Underlying all the bank crisis, debt crisis, all of that, we can see something very important, and that is derivatives. But people don't even understand what that really is. So here, I'm going to make it real simple. My name is David Quintieri, and I've been looking into all this financial wizardry for well over a decade, and I've been bringing out these videos and trying to dissect it in a way that makes it real easy to understand. You see, what's happening with the bank crisis right now is only understood by a select few, and not even those in the financial industry generally pick it up. I mean, they just don't get it. So I'm going to give you some info that is priceless. You've got to know this in order to realize what's going on with Credit Suisse and SVB and all these other banks. You stick with me. I'll explain this right here and now. First things first, okay? We've got to talk about something called CDDC. Not CBDC, Central Bank Digital Currencies, but CDDC, and that is Credit Derivatives Determinations Committee. That's a mouthful. It's a body that decides whether payouts should be made on insurance-like products called credit default swaps, or CDS. Now you're going to see those all the time in these articles. CDSs, I covered one just in a recent video talking about how these bets essentially, these are a form of protection or wager on a borrower's ability to pay back their debts. If you can imagine this, right now, they're actually more risky for the United States than they are for other emerging markets. I mean, it doesn't make sense. You're saying, what are you talking about? How could the emerging markets be less risky? Because of the whole debt ceiling crisis. They have determined with their financial wizardry that this is the right thing. Okay, don't ask me. I didn't make up the rules, and this is not my field where you look at derivatives and what should be priced in such a way. These are all done behind the scenes by some PhDs and everything else, okay? You gotta imagine lending someone money and buying an insurance in case they can't pay back. That's what a CDS is. The question of whether and when insurance should be paid is decided by the CDDC. So here we are, okay? I hope you got where I am right now. If you want to know one instance in history where credit default swaps were like so big, it was with Greece. You remember the whole, what I call Euro viral contagion in my first book? Well, that was 2011 into 2012, and that whole thing was getting wild, and it was Greece that was really affected, and some suggest that they were punished by these credit default swaps. The interesting part here is that the CDDC was recently asked to make a decision involving billions of dollars of securities tied to the bank Credit Suisse, which had been bailed out. If you remember, I was covering it here on this channel. It was obviously everywhere. I'm sure you're aware of what was going on. One bank after the other, they're all failing. Before we look into that, we need to understand what the CDDC is and how it works, okay? So in the past, it was the buyer or seller of a CDS who decided whether a payout was necessary. But as the market grew, the industry created the CDDC, a panel of experts whose rulings must be followed by everyone in the market, okay? Now, all this, yeah, I get it, jargon, but just understand I'm tying it into the banking crisis and debt ceiling, okay? Today, the CDDC is made up of 5 regional panels, each with lawyers from around a dozen institutions active in the CDS market. So I look at this and I think to myself, you've got all this wild, crazy nonsense happening today. They're trying to stabilize this, but also they're choosing winners and losers. That's the way I see it. You might be wondering how they decide whether to trigger a payout. They ask yes or no questions like, has a bankruptcy event occurred? And use publicly available documents to make their decision. Their vote is made public, and if four-fifths agree, the ruling is final. If not, they call in an external expert to help them agree. So this is what, by the way, takes so long. There's so much red tape. If you've ever worked for a financial company, you know that any small decision alone on those financial companies takes forever. And then you go into these supranational bodies and it is just obscene. The CDDC has a lot of power as it decides the fate of a massive amount of money. As of December 2022, the CDS industry was worth nearly $10 trillion. This makes it crucial for the CDDC to be consistent, helps predictability of investors to gauge that risk. Like, what is the risk of a US default right now today? And they started to price that real high. So that's the way it's looking anyway. Of course, being such a powerful entity, they have criticisms, particularly around potential conflicts of interest, since the members have a stake in the industry, right? They've got rules in place to mitigate this, supposedly. And that brings us to the recent case with Credit Suisse. The panel had to decide if the rescue of Credit Suisse by UBS should trigger a CDS payout. So you probably were here on the channel, you saw all that. Just like with SVB, just like with JP Morgan doing this wonderful bailout that they did, same situation, UBS and Credit Suisse, okay? This happens to be Switzerland, it can happen anywhere really. Eventually it was decided that it should not, due to the nature of the instruments underlying the CDS contract. The decision has attracted a lot of attention for two main reasons, okay? So the first thing here, a huge sum of money was involved. Also, the bailout was controversial as it wiped out some of the debt holders. They call this a bail-in. If you remember, just recently they were going through this and saying, hey, whoa. And if you could believe it or not, there's actually an ongoing lawsuit. There's actually litigation happening right now today. We don't know what's going to happen with that. We'll see. But I think it's just interesting and it ties in all of this together. So now you're aware of that, okay? The CDDC, it's a critical player in the world of finance. It helps navigate these situations, making sure that, it's fair, it's balanced. Whether or not that's the case, we'll have to see. But I think the point here is that we now have a way to understand this at more depth. We know what a credit default swap is. We know who the CDDC is. And we understand how this ties in to the bank crisis, but also to any event like the debt ceiling. As risk appears, these credit default swaps start to rise. Wait a minute, we've got risk over there. And then investors or speculators, they start piling into that trade. And you know the way things work, like a snowball, like it rolling downhill, it starts to get more and more and it picks up steam. And that could actually cause a problem like we saw with Greece. Now it's been over a decade. So we get all these points all together, connecting all the dots. You watch this video, now you've got the knowledge. I really do appreciate you for being here. Do you know anybody that is interested in this type of information? Definitely share it with them. Hit that thumbs up button. I'm going to be referencing this video forevermore, hundreds and thousands of times. So I hope that you found this informative, and I'll see you tomorrow. Take care.